Thank you so very much. Appreciate it. Today, we're going to change some things up a little bit. A lot of times advisors always want to talk about, do you have a plan? But what we're going to talk about is, do you have the real plan? The real plan is, we're all hearing in the press about this potential monetary cliff at the end of this year. Has everybody heard this? Anybody concerned about this? Okay, well, we should be concerned about this, because it's going to affect each and every one of us here, one way or another. The other thing we're going to talk about, and I'm going to turn this over, is the third and fourth quarter earnings review. I'm going to turn this over to Benjamin Kennedy. The European stagflation. Also, what we're facing here is deflation or inflation. And then lastly, I want to close, that again affects all of us here, is the future of the cost of doing business. Okay? So on the monetary cliff, if nothing is done, Citi research analysts forecast a 20% drop in the stock market, and a Congressional Budget Office has said a recession would result. Now that is if they do nothing. Now you go, now that doesn't make sense. Well, if they do nothing, we're going to immediately go back to the pre-Bush tax cuts, is what's going to occur. And then on top of that, we have the Obamacare that's going to be kicking in next year. And that's going to be increasing everybody's taxes, despite what you're hearing with the debates. We also have a potential, what they're working on, what's called the grand bargain. Now the grand bargain, I'm going to be really frank with you, is by no means a solution. The grand bargain is just basically going to take $4 trillion of the deficit reduction over a 10-year period. Now, $1 trillion sounds like a lot, but unfortunately, that is nothing when it comes to where we are headed. This means higher taxes regardless of who is elected. And currently, what we're looking at, if the current administration does become reelected, the Obama administration, we're looking at a 39.6 tax rate. That's what the highest tax rate was under the Clinton administration. We're looking at a 39.6 dividend income tax rate. Then we're looking at a 20% tax rate on capital gains. So that means next year, the federal income tax rate for the highest earner will be 43.4%. Plus, you have your state tax on top of that. So you're looking at your tax rate well over 50%. Now, that does not also include if you want to go out and purchase something, because remember, we also have a sales tax, right? So that, technically speaking then, if you're in the high tax rate, for you to purchase something, you're going to basically lose around 60% of your income to buy. That is substantial. So this monetary cliff, we're basically telling our doctor clients that you're going to need to get your lifestyle or your spending in some type of order because of these high taxes. Now, I know some of you here do not spend this type of money, but we basically did a what-if scenario. What is the maximum that you could spend a month without having to go into this highest tax rate? And that's basically $14,000 a month. Because if you add your taxes on top of the $14,000 a month, that puts you over the $250,000 threshold. Now, I know a lot of us here are not at that $14,000 level, but I think it's important to understand what we're facing. Then the other thing we want to do then, if we can get our lifestyle in check, is we want to be able to shelter this income. Now, how many of us here have pension plans? Okay? Pension plan is the greatest shelter there is available out there for you, because everything you put into a retirement plan is at your current tax rate savings. So if you're in the highest tax rate, you'd be saving roughly about 45% a year pre-tax. Most of you are probably somewhere in the, combining with the state, you're probably looking at about a 35% that you'd be putting away into a retirement plan. So we need to be able to position ourselves, besides putting everything in a retirement plan, is this potential drop in the stock market. And I'm going to turn this over to Benjamin Kennedy here to talk about this. But before I finish to turn this over, as you can see on this last chart, this is what our deficit has been looking like. And this is since the early 70s. So as you can see, we are having some serious expending problems in this country.
Thank you. I'm Benjamin. I work at the trade desk. Danny asked me to speak a little bit about the investments in the 20% drop. For the past 2 weeks, we've been shorting the stock market. It's fallen about 4.5%, 5% since then. It's down between 0.5 and 0.7 today, and it's just going to get a lot worse. And there's a reason for this. A couple of months ago, we sent out a letter to all of our clients that said that third quarter earnings aren't looking so hot, but the stock market continued to go up. So we started repositioning in cash, and then eventually we started shorting. And we were either really lucky or we just saw it coming. But this third quarter is nothing compared to the fourth quarter. Fourth quarter, about 90% of companies are going to miss their earnings targets. Analysts are going to have to downgrade, which means lower stock prices. So we could see this pull back another 10, 20%. I don't want to say any more than that. I don't want to be huge there. But one thing you need to look at is what businesses are spending on new equipment, software. Caterpillar buying new factories and such. It's actually gone negative. Corporations are sitting on a lot of cash, but they're not putting it to use. And there's a reason, is because they know that consumer spending is not looking so good in the fourth quarter. So they're just going to sit on cash. So what do you do with this? Most of you here probably have mutual funds. Some of you might have a hedge fund. And so you're just going to have to write this down. You're probably down 5% the last 2 weeks because you're not in cash. And that's just the way it is. You buy and hold. It's a lot of work for advisors to constantly reallocate your portfolio into different sorts of investments. They just say buy and hold, buy and hold, buy and hold. But that doesn't work right now. What you really need to do is go into cash, short the market. If you don't believe in that, just remain really defensive. Buy commodities, buy other currencies. Buy managed futures. That's a little bit complicated to talk about. We'll be hosting the bar this evening. You can come talk to me about managed futures. And again, cash or treasury inflated protection securities. Those are really good investments. One thing that we look at, and this bottom chart, is durable goods, which is basically what we purchase, compared to the stock market since 1997. Durable goods are on their way down. We just had a little bit better number just yesterday, I believe it was. But all of that was due to aircraft, so it's not a real good indicator. Durable goods are coming down. In the past 3 recessions we've had has always been because durable goods has been a leading indicator of that. And of course, this chart's a little bit old. We showed this to our clients a couple weeks ago, and since then the stock market has gone down pretty significantly. The first chart you see is easy money, the easy money supply, the M1, M2, M3 money supply. The stock market was doing normal amounts of returns until the 90s. And you all probably remember the 90s. Everyone could make money, just put it in the market. Unfortunately, easy money died and it collapsed. So the banks started putting out easy money. That's the 2008 bubble. That collapsed. Now we have government debt bubble. This one's really easy to see. It's the top right. You see where it's not as smooth as the first 2 bubbles. You see a little bit of jaggedness, a little bit of whipsawing action there. That's because we have to keep printing money. QE1, QE2, QE3, this government debt bubble. So you have to watch out for this. They're also doing this in Europe. And I think Germany is one of the best places to look. They say as Germany goes, so does the euro. I won't bother to read all this to you, but Germany's not looking so great. The numbers don't look really good. The fundamentals are not great. They're having to give a lot of money to other countries. I would not invest in Germany right now. A lot of really smart people, the smartest people in the room over there, are taking their money out of the market. And there's a reason for that. In America, when we went to cash, it was 6-to-1 the ratio. 6 stocks for every one. CEOs, the most brilliant people in America, were selling 6 stocks and only buying 1. That number today is 11-to-1. People with $10 billion are selling 11 stocks to every one that they buy. You can find this, SEC Form 4s, insider trading, legal insider trading. It's easy to see, people just don't pay attention to this. If they're selling, there's a reason, and you need to think about this. So what do? How do you get around this? Well, corporate bonds. Apple's sitting on $110 billion in cash. They're doing fine. Buy some corporate bonds. Don't go out more than 3 years because of inflation. You have to actively manage this. Do not buy and hold. Obviously, do not buy a mutual fund because that's buying and holding. And this is an interesting statistic I don't think a lot of people realize. But hedge funds, where billionaires put their money, they're only up 1.44% a year over the past 5 years. It's not very good. That's because we keep seeing this correction in the market. So buying and holding is not going to get you there. All right, so who thinks we're going to have deflation? Who thinks we're going to see inflation? Right? If you've been out to the stores and you've shopped for your children, gotten food, you realize that we have real inflation, not what the government tells you. This is a big problem. It's because we are printing $85 billion a month in stimulus, and our GDP is only 1.5 to 2, today it's 2%. We're not getting anywhere. We have $1.3 trillion a year that we're in debt. And also our trade balance. We have this trade balance deficit of $44 billion. That's huge. That's every month. That's $500 billion on top of that. So $1 trillion plus $1.3 trillion plus $500 billion. It's about $3 trillion a year that we're negative in America. So what do you do to get around this? Well, again, high yield corporate bonds. Corporations in America are doing just fine. Don't go out more than 3 years. Actively manage your portfolio. Don't just buy gold currencies, manage futures. The same thing. You're hearing the same things over and over here. The cost of doing business. This one's for Danny.
Thank you. We're not here to scare you. We're here to educate you. I think that's what we're here for. And remember what I said at the very beginning. Do you have a plan? If you don't have a plan, you plan to fail. And I can tell you right now, doctors do not like to fail. That's just not your MO. And as I always tell my clients, a doctor is a geek with an A personality. You guys are highly driven, highly motivated, and we want to make sure we keep you on target to do that. Now, the cost of doing business, we think there's a possibility there's going to be an unplugging of Medicare, because next year they're going to be cutting Medicare. They have to cut Medicare as one of the budgetary items. So here's the scenario. Your taxes are going up and your reimbursements are going down. That doesn't sound very good, does it? So what we think is going to possibly happen is, because of doctors unplugging out of Medicare, that they're going to come up with some type of requirement to mandate you to see a certain percentage of Medicare. That bothers me. Also, the tax hikes might possibly increase every few years. How many remember Ronald Reagan when they changed the whole tax basis in this country in the 80s? They promised in the 80s, Ronald Reagan promised that our taxes would never go back up if we signed on to the new Reagan tax rates. Well, unfortunately, that's not been true. We constantly keep seeing our tax rates going up. The other thing, the cost of doing business, is the self-employment income tax rate is going to increase from 2.9 to 3.8. And then lastly, we're going to start seeing more and more government oversight into our businesses. So again, as a group of doctors, you need to make sure that you have a plan so that you can combat this. Now, one of the programs that I just came back with is called MDVIP. You can look it up on the internet. And this is a program of concierge service, and it's something that I think as a group that you might want to start thinking about and looking into, is how to carve yourself out on more of a concierge service type of program. And again, lastly, if you set yourself up right in your corporations, and you need to make sure you're incorporated, either an S, a C, or an LLC, does not matter, and you set your salary and pay taxes on your salary, and you defer the rest of that, then you can get ahead of the game. For example, Devon. Everybody knows who Devon Corporation is. The CEO of Devon is Larry Nichols. Do you think Larry Nichols pays taxes on the gross income of Devon? Of course not. He takes a salary out. That's exactly what we want you to be doing, is just take a salary, pay taxes, everything left over in that corporation, you're going to defer out, and you're going to put it into one of these 415 defined benefit plans so that you can turbocharge your retirement. Okay? All right. I think we've been here long enough. Again, we'll have the open bar. Unfortunately, I won't be here. I'm going to have to be up in Stillwater. But come by, talk to Benjamin Kennedy, and he'll be more than happy to spend some time with you, especially on managed futures and some of these other options that are available. Again, thanks.